Hello, everyone. My name is Zulfiqar, and welcome to another episode of Income Investors. With me today is John Whitefoot. But before we go into any details, I want to let you know that anything you hear in this video is for information and educational purposes only. Nothing in this video should be taken as personalized investment advice. Investing comes with risk. To read more about it, please see the description below. Inflation is cooling, but as we all know, interest rates are still on the rise. Now, rising interest rate may not be something that average Americans or businesses like to see. After all, rising interest rates increases their borrowing costs, and obviously it makes it difficult for them to, borrow, expand, and so on and so forth. But rising borrowing costs are what banks live for. And again, let me tell you this. With that said, not all financial institutions are built the same. One niche area income investors should pay close attention to are the business development corporations. And in particular, Triple Venture Growth BDC Corp, traded on New York Stock Exchange under symbol TPVG. But first, John, give us a little background about BDCs.
Yeah, thanks, Mo. We nickname these firms alternative banks here at Income Investors because they operate much like traditional financial institutions. And thanks to a quirk in the tax law, these firms pay out some of the highest yields around. Why? I'll give a little history, but hopefully not too much. So back in 1980, the U.S. economy was knee-deep in a recession. In fact, its worst recession since World War II. 1 in 10 Americans couldn't find a job. The Dow Jones Industrial Average was trading at the same level it had a decade earlier. And the average rate for a 30-year fixed mortgage, which had doubled in the span of just 2 years, tops 16.4%. At the time, then President Jimmy Carter saw part of the problem. Small and mid-sized business owners are the economic engine of the American economy. So companies with 500 people or fewer employ over half the American workforce at the time. They also sparked many of the innovative ideas needed to grow the economy. But sky-high inflation rates have cut off these entrepreneurs from the funds they need to expand their businesses. And without access to capital, many can't invest in new property, plants, or equipment. So the administration comes up with a solution. So on October 21st, 1980, Carter signs into law the Small Business Investment Incentive Act. And the law allows for the creation of a unique type of financial institutions, which are what we know today are BDCs. And essentially overnight, the government created an industry designed specifically to encourage venture capital lending to small and mid-sized businesses. Since then, BDCs have become indispensable for burgeoning small and middle-sized businesses. And in recent years, dozens of BDCs have popped up to service different types of customers. For example, a Texas-based BDC might focus on lending to oil and gas companies, where a California-based firm might devote itself entirely to Silicon Valley startups.
And John, I want to know, what are the advantages of BDCs for income investors?
Yeah, that's a good question. BDCs are a financial lifeline for many companies. Because of tax breaks, are also a great option for income investors. Traditional financial outfits have to pay the government between 25 cents and 35 cents in taxes on every dollar they make in profit. Under the bill that Carter signed, BDCs pay little or no corporate tax on their earnings. And in exchange for this benefit, BDCs must distribute at least 90% of their ordinary taxable income to shareholders. And as a result, these companies pay out some of the biggest dividend yields around.
What can you tell us about TriplePoint Venture Growth BDC Corp?
Well, every investor knows that you can make a fortune by investing in the right Silicon Valley company. The amount, of course, depends on when you get involved. Investors and venture capitalists like Bill Gates, Peter Thiel, and Neil Shen, they don't wait until companies go public. They get in on private tech stocks before they launched their initial public offering. But California-based BDCs offer a loophole. These firms provide startups with the financing they need to grow their business. And in return, the BDC receives an ownership stake in these companies long before their stock debuts on Wall Street. And that's what makes Menlo Park, California-based TriplePoint Venture Growth BDC Corp such a compelling option. The company specializes in companies at the venture growth stage of investment. It primarily invests in technology, life science, and other high-growth industries. The company's sponsor, TriplePoint Capital, has provided over $10 billion in commitments to more than 1,000 venture capital-backed companies across the globe. Of that, TriplePoint Venture Growth represents more than $1 billion. Now, when I say BDCs target small and mid-sized businesses, that doesn't mean mom-and-pop shops. BDCs typically lend to companies that generate between 20 million and 100 million yearly in sales. And if you can judge a BDC by the companies it invests in, and really you should, it's tough to beat TriplePoint. It's been an early investor in some of the tech industry's biggest names, including Facebook, Etsy, Shazam, and YouTube.
If I understand correctly, the demand for debt financing remains strong these days.
Yeah, absolutely. In the first quarter, ended March 31st, TriplePoint reported total investments and other income of $33.6 million. That's compared with $27.3 million in the first quarter of 2022. First quarter net income, meanwhile, was up 38% at $18.6 million, or 53 cents per share. During the quarter, the company entered into $3.7 million of new debt commitments with one portfolio company, and funded debt investments totaling more than $57 million to 11 portfolio companies. During the company's just not giving out money. During the quarter, it also received $3.4 million of early repayments and $16.6 million of scheduled principal amortizations.
John, now let's talk about the exciting part here. I understand that this company increases quarterly distribution by 8%.
Yeah, absolutely. Strong net investment income allows TriplePoint to reward its investors with a very generous dividend policy. Most recently in May, it declared a second quarter distribution of 40 cents per share, or 13.17% on an annualized basis. The company last raised its quarterly distribution in the first quarter by 8% to 40 cents per unit from 37 cents. TriplePoint has actually declared total distributions of $13.85 per share since its 2014 IPO.
Talk about its share prices. We want companies with rising share prices and strong dividends.
Yeah, it's the perfect combination. They're, again, as you just mentioned, distribution is up 8%, the quarterly distribution, and their share price has been doing well as well, up 6.7% over the last 3 months alone, and 26.7% year to date.
All right, John, thank you so much for talking about TriplePoint Venture Growth BDC Corp. It is a leading BDC devoted to venture growth stage companies in technology and high growth industry. With a strong balance sheet and a strong portfolio of companies, its objective is to target return of 10 to 18% on debt investments from interest and fees. Over the past few years, management has positioned itself at the forefront of emerging industries from digital marketing and biofuels to social media and healthcare. In addition to getting investors on inside track of the next generation of tech IPOs, TriplePoint is also home to a reliable high dividends. That's it for today. If you want to read about John's ideas, you could head directly to www.incomeinvestors.com. We'll be back with another video soon. In the meantime, don't forget to like this video and subscribe to our channel. Goodbye for now.